Hey everyone, welcome to the live stream. It is May 21st. It's after the market is closed. It is 6:30 Eastern, and I wanted to talk about the stock market. It really sold off today. I think it's a combination of a few things. First, the Moody's downgrade of US debt is causing in general an increase in interest rates. It's causing one more big topic that is going to drive concerns and fear of uh, really the U.S. economy, U.S. debt, and higher interest rates means that stock prices will go down because the discount rate, if you recall, when I discount free cash flows or future earnings, you discount it by an interest rate. And if interest rates go up, that discount rate goes up. So stock prices will go down because higher interest rates will slow the economy down. It'll make it more expensive to buy a house, more expensive to buy a car. Just everything goes up in cost. Companies that issue out debt in the form of bonds will have to pay a higher interest rate. The US government will have to pay more interest on its debt. Those things are bad because you end up consuming a lot of either US government budget or corporate budgets on interest payments. So that was a bit of big news that the market, I think, is digesting. It's trying to figure out what's going to happen. And right now in Washington, they're trying to figure out the next budget, the next bill for spending. And I think there are some that want to see more cuts to the overall spending, and they're going to need to find a go forward plan there. I hope they find one that does reduce spending, man, because the US does have a lot of debt and it can go from bad to worse over time. So that was the general big story of the week. Earnings have been good. I've been looking at earnings that have come out. Several of them came out today and they were positive. So I wanted to talk about those in this stream. We're going to talk about Zoom. We're going to talk about Snowflake, Medtronic, and a couple of others that announced earnings. They look good. So I would say that the sell-off is not due to poor earnings. It's actually due to more concerns around the U.S. debt levels. So that is one area that I want to cover. The other big topic I wanted to cover was Google. And they had a big, I'm going to call it presentation of all their technologies related to AI. And it was really well received. I watched the video. I encourage you, if you're a Google stockholder, or really if you're an investor in technology, I would encourage you to look at that video because it's about, I think the summary is about 20 minutes long. And it is really impressive what Google is up to, everything they've been doing. I was really impressed. So the stock today was one of the bright spots in the market. The day after that big presentation, the stock is up 3.4%, while everything else is really deep in the red. So maybe this is the beginning of a good rally for Google. Heaven knows it needs it. It really does. So we'll take a close look at Google. I've got a lot to say there. I'd love to review your stocks, a couple things. If you're a paid member, put a stock symbol in the chat. I will cover it. If you're not a paid member, a $5 super chat will get you a membership. So consider it. And I'd really appreciate the support. You can become a member quite easy. You can just go to my website, not my website. I would say my channel homepage, and you go on the join section, which is in the middle of the page. And you can look at the 3 different levels of membership. Pick the one that's best for you, and you're a member. You'll be able to request tickers on live streams. You'll be invited to member-only calls. You'll have access to member-only content. So it'd be great to have you as a member, and I would really appreciate the support. Thank you. All right, so we had a lot of red stocks. How did the different industries do today? So when we look at sectors, the worst one was real estate. Those high interest rates are going to make real estate just more expensive, less valuable. So real estate companies took a bad hit. Communication services took a bad hit. Energy, financials. On the opposite end of that, healthcare did okay today. Utilities, consumer staples. And consumer staples start to rally when everybody else was afraid. They want to get out of growth and go into something safe. Year to date, the utility sector is leading all sectors in the materials and consumer staples. Worst performing is energy. So that's where the stocks have been performing, as in utilities, materials, consumer staples, year to date. All right, so we went over the sectors. Let's take a look at the big names, cap stocks. Microsoft lost a little bit today, but they're doing okay year to date. NVIDIA didn't have a good day. It looks like they have a small loss year to date. Apple's the one that, boy, I'm sure a lot of investors are really beginning to feel the weight of that big market cap. Apple has lost a fair amount, and it's lost 19.3% year to date. It lost big today, and I just don't see what catalyst is going to be out there for them. Google just revealed a lot of their catalysts, which is they really do have a very strong AI lineup, and it looks really good. But Apple, what do they? They don't have anything. They have an iPhone. They update it, and they hope that people buy the update. I don't think that's going to be compelling anymore. But we'll see. I think they're the worst off out of the top most valuable companies. You have to go down to Tesla to see the next closest second place loser, I guess. And that's where we're at. Google had a good day. Boy, they needed it, or they'd be keeping Apple company on really big losing stocks. They are losing about 11% year to date, but they made some good progress today. All right, so let's get into some individual stocks. It's good to see Muhammad on the stream. Thanks for showing up. I appreciate it. Bad Omen, how are you, sir? Good to see you. Thanks for joining. Let me get into some stocks that I wanted to review. Let's stay on that Google thread and get into Google. Let me see if I've got. All right, go from here. So Google had a good day, and they've got a loaded lineup. I mean, they've got a ton, robo-taxi, autonomous driving cars in Waymo, and it's real. They've been operating for a while. So it'll be interesting to see how big that business gets. And that's AI. No doubt about it. That's the real deal, AI. What other things? The AR glasses. So if you recall, Google had Google Glass like 15, 20 years ago, and it was a real big bet. They ended up postponing the product altogether. I don't think they had the market for it. But now they're coming back. They're coming back with a pair of glasses, and Meta's been having some success with their glasses, that they have a partnership with Ray-Ban and have put together some nice AI glasses, or AR glasses, excuse me. And Google's got a product there. Along with that, you have when they announced their usage of Gemini, which is Google's AI foundation platform, the tokens that users are using of Google's products far exceed everybody else. So the whole notion that Alphabet was behind is wrong. They're actually ahead, and the facts are behind them, because A third party measures this. It's not Google saying it. It's the measure by the marketplace. And you see the growth that they've seen in the amount or the usage of their AI platform. So good for them. So I was really impressed with the IO um, conference and the presentation. I encourage you to watch it. I got a lot out of it. Google is probably the best, I think priced big cap stock. It's a $2 trillion market cap company. Revenue is 359. Let's call it 360 billion. So you're paying about 6 times revenue for this really good company. PE is 19, forward PE 18 and a half. Analysts like the stock and they think it's discounted. Look at this growth here. 13%, and they are this big. I mean, it's just really impressive to see them. Is that growth going to continue? I think so, because their YouTube business, YouTube is the leader in streaming, and it continues to grow because advertisers want to use YouTube for advertising. Their Google Cloud business is growing really well, and so is search. Search revenue has increased. So all those things to me mean that they are going to keep growing. So I really like that. So it's a nice growing big cap stock. When we get into free cash flow and margins, free cash flow, almost $75 billion. Huge number. And look at this growth. They went from 22.8 up to 74.8 over the last, call it 6-7 years. Tremendous growth. That shows the intrinsic value of this business. They keep loading that balance sheet with cash. They can fund these big special projects like robotaxi and the AI projects they're doing, making themselves stronger, more valuable, or more relevant, and kind of constructing their future. So that's why Google is worth $2 trillion, is all those cash flows. They're also a good margin business. Now, they are providing more services in Google Cloud, as an example, and their margins are lower than the margins on YouTube or search, which are very high. Overall, 58.59% is a gross margin. Profit margin, 30%. What a great number. Free cash flow, 20.82. Terrific numbers, just terrific numbers from a big company that's growing. So those things look excellent to me on Google. Their balance sheet, just for fun, let's see what kind of cash balance they have. They have $95.33 billion of cash. They could buy Zoom for cash. They could buy Lyft for cash. Both of those could be pretty decent acquisitions for them. And they have debt of $28.5 billion. So a real big surplus of cash, $66.83 billion surplus of cash. They could pay off all their debt immediately. So their balance sheet's really strong. And analysts, a lot of them are out there. 40 of them cover the stock. There are some analysts that believe it's priced at a big discount. And there's some that are not completely sold on Google, but their price target is only $11 below its current stock price. That's not bad at all. Downside risk is, I think, moderate. Upside risk is really good, or upside potential is really good. So I like that situation. You're buying a company that has a terrific business, that has a very bright future for a discount. The current year earnings per share is going to be $9.86, and it's going to grow nicely over the next couple of years. So Google just really set to be profitable. It's set to generate great free cash flows, and I think it provides a terrific discount. If you want to see that discount, become a member. I share it with members. I share my valuations with members, and I actually do member-only content where I go all the way with analysis. So take a look at the membership program. I'd love for you to see it and see what I think on the valuation of this company. So that is Google. They're terrific, and I'm glad I owned Google. It's the second biggest position in my portfolio. Hasn't been performing all that great, but it had a good day. It was good to see that. A stock that announced today is Zoom, and Zoom is up slightly in the after hours. And Zoom is steadily growing. I think they're growing at 3% was their growth rate on the earnings. They are kind of a value play now because you're buying a company for 25 billion market cap. Revenue is 4.7 billion, so you're paying less than 6 times revenue. The PE is 24, forward PE is 15. The reason the PE is not any higher is that they're not growing very quickly. 3% is not a lot of growth, but they are growing the amount of cash they're producing and the profits, which is encouraging. They're buying a lot of shares back. You see their cash flow, they continue to grow their cash flow. That's very good. And their gross margin, 75.85, profit margin of 22%, free cash flow margin of 36%. Those are terrific numbers. So they're growing their profitability and they're growing their free cash flow. So that is a very positive. I think they're a good acquisition target because somebody who wants to take the Zoom business, make it a part of their larger business, and then have one more category of sales, I think that would be a really good idea for a business. So Zoom announced today, the stock isn't really moving. I think it's a really terrific value play, and they have a terrific balance sheet. The cash on the balance sheet, $7.79 billion, and they only have $35 million of debt. So they have a surplus of cash of $7.76 billion sitting there on the balance sheet. They've been buying a lot of shares back so that it makes all the remaining shareholders own a bigger portion of the company. That is great. Good job, Zoom. And it's a business that they have become, a very specialized company, but they do it really well. It is, I believe, the more popular platform. Microsoft has a solution, so does Google, but I tend to see Zoom out there far more often. I think it's a better experience for those that do a lot of video conferencing. So Zoom had their earnings. The stock isn't doing much. What is the market doing? I wonder what the market's going to do tomorrow. It's been a down week. I imagine it could trade down. Maybe we're seeing the early signs of that occurring. All right, so first we had TJ Maxx. TJ Maxx had decent earnings. They had small growth, around 3%, but they did contract on their cash, and their inventory did go up, which isn't good. I don't know what their stock price did today. Let's take a look. This is a discount retailer you guys may be familiar with. Yeah, it was down 2.89%. Interesting. Lowe's announced. What did Lowe's do today? And I think Lowe's announced before the market opened. It was down 1.68. Now, I wouldn't read too much into that because a lot of stocks were down. It wasn't just Lowe's and so forth. Medtronic was out today. Stock was down, and looks like they loaded the earnings. Take a look at the quarter. It looks like revenue grew almost 4%. That's good. That's really good. So Medtronic, they didn't rally today, but again, most stocks sold off today, so I wouldn't read too much into that. All right, so till the end, what do I think about TSM? The last time I looked at TSM, it was priced too expensive. I think they've done really well as a stock. TSM over the last couple of years has really done well. I owned TSM for a long time, made money, got out. I got out like around here. In 2022 is when I sold, and I got out around here. The stock did come down, but ever since 2022, the stock's really up 209%. But I think the stock price has gotten above its intrinsic value. So I'm not buying TSM. I'd be selling TSM. That's how I feel about TSM. Bushy 1147. How are you, sir? Good to see you. Hopefully you're doing well. Hopefully you're getting through this market this week. It's been a little down, but let's see where there's opportunity. So that's TSM. One stock that came out, and it's interesting, is Snowflake. And Snowflake came out with a lot of fanfare right after COVID. And what Snowflake is about is a lot of companies use these cloud platforms or cloud infrastructure from AWS, Amazon Web Services, Microsoft Azure, which is a big cloud, and then Google Cloud. And what Snowflake has done is they've decided to be kind of a data company. They will manage the data in one of those clouds. So when you have these big systems or big workloads in one of those clouds, you're going to need a lot of data. So Snowflake has made themselves the specialist in holding, managing, storing that data. Now, the idea was good. The stock came out. It flew up to, $380 or so per share. The market cap of the company was really high, and then it tanked. It went down big. At one point, it went down 68%. The lowest point from the top, it went down 72%. And it hasn't recovered like, the Metas and the Netflix and NVIDIAs. They more than recovered the recent highs and flew past them. Not this stock. This stock has not gotten back anywhere near its highs. Well, they announced their earnings this evening after the market closed, and the stock is up 7.3. Now, when we look at Snowflake, it is impressive that they're growing their business. They're growing by, looks like 27.5 over the trailing 12 months. For the most recent quarter, they grew at 25.75%. Now, that is good, very good. They're still, you can't call them a small business. Now they have a run rate of above 4 billion. That's looking good. But when we look at their margins and free cash flow, it's not really exceptional. Their free cash flow has been kind of flat for a little over 2 years, which is a concern for me because I value companies on cash. Their profitability, their margins have come down a tiny bit. It's not the most profitable company out there. Their profit margins, they're not profitable. So they don't have a profit margin. So when I value this company, I actually come up short on the valuation and think that Snowflake is priced too high when I value those cash flows. The current market cap is 60 billion. At one time, man, it was almost 200 billion in market cap. And this is a lesson that the market sometimes gets way ahead of itself. The fundamentals were terrible a couple of years ago, but the stock was trading way up here. And part of it is that when a company doesn't have fundamentals, the market can imagine whatever. Oh, it's going to be gigantic. But then the earnings come in, they go, whoa, it's not going to be a $20 billion revenue company per year anytime soon. It's just trying to become a $1 billion company, and then 2 billion, and then 3 billion, and then 4. So the market really cut down the valuation, and the company sold off. Now the stock is rallying again, and I still think the stock is priced too high. What do other analysts think? Other analysts, some of them think like I do, that it's priced too high. 40 analysts cover it. And the biggest bears think that the stock really is worth $121 per share. And right now it's going to trade at 191. So that's a big haircut if this analyst is correct. I think I'm right around that number. I think these guys are too expensive based on free cash flow and earnings per share. So that is Snowflake. And when I value Snowflake, I looked at their earnings. I actually get to a 46% premium you have to pay on this stock. And there's a lot of companies that are doing data management, right? You have database businesses, you have other cloud services businesses. They're not that unique. They could say that they're a little better. I would agree with that. I think they do certain things well, but they're just priced too high. And the market did punish investors that bought incorrectly. You don't want to be this investor where you buy at a high and then see this come down. Now, when we look at other software companies, and I'm going to pick on Palantir for the moment. Palantir is just a huge success story from a price of the stock perspective. But you look at the valuation of Snowflake, they're growing at 25%. When we look at Palantir, it is growing at 33%. Well, that's a bit higher than 25, but the valuation is just really, really, really high. 523 PE. Wow, that is expensive. Forward P 195. This is a really expensive stock. Where is this going to land? I think it's going to land at around $50 a share at some point in the future, and it'll be a painful ride. But we'll see. We'll see if the market continues to buy into the story and doesn't care about the fundamentals and the fact that fundamentals cannot get you to the current market cap and the current stock price. Then the stock will continue to trade up there. Tesla also has a similar following. You know, some investors really like Tesla, but the fundamentals don't support the stock price. The value based on free cash flow and earnings per share on Tesla is far lower, as it is with Palantir, but it continues to scream up. Snowflake did not, I guess, capture the market's, eye like Palantir, and its stock really came down and has stayed down for the most part compared to its all-time highs. So Snowflake did not get that rock star status, that celebrity status as a stock. So the Snowflake stock should rally tomorrow, but I think it's priced way too high. And we'll see where it trades over the long haul. All right, so it looks like we have 24 people on the stream. Thanks everybody for joining. Let me know what topics you want me to take on, and I will take those on. Let me see what are the earnings we had. So we had Medtronic, and I think I talked about Medtronic a bit. Medtronic is a med device company. They do certain devices to help people with certain conditions. They need a pacemaker. They need defibrillators. Those types of things for people. They've been around for a long time. Really well-known company. $108 billion market cap. Revenue is $33 billion, so you're paying 3 times revenue. And the PE looks pretty good, 23. Forward PE of 14.5. The stock hasn't worked. Interesting. This is a big company, but their stock just hasn't really done anything for investors. It's been kind of a flat company. It just kind of continues to exist. Do they pay a big dividend? Yeah, pretty decent dividend, 3.32. Now this is what they would call a value trap. You see a lot of value, you see good fundamentals. The stock doesn't do anything. Just sits at around the same level. And I don't know that it's going to change because I don't see a big catalyst. I don't see any exciting news in the company that I'm aware of. It's just going to continue to operate, and that's it. I would probably stay away from this stock. I've never been an investor in Medtronic. I don't know if there's any Medtronic stockholders. Jay Zev, how are you, sir? Good to see you. All right, so that is Medtronic. So let's see what other earnings were out there. So we had Snowflake. The earnings were good. Stock is going up. Target earnings were, I think they were not good because it's retail. And I think the stock price sold off. Baidu. What happened over at Baidu? This is a Chinese company. So Baidu provides online marketing and non-marketing value-add services through an internet platform in the People's Republic of China. It operates two segments: Baidu Core, and IQIYI. So this company does search, marketing services, cloud services. Interesting. Hey, Ben Peoples, how are you? You want to look at Visa? Glad to do that. One second. Let me finish my thought on Baidu, and then we'll hit Visa. So we got this company. Let me get my bearings around this company. So they do. So they do search. They're doing AI. And then online entertainment, video streaming, and so forth. Okay. AI cloud. Okay. So this is a technology company. It kind of reminds me a little bit of Google, and they're in China. Their stocks sold off today. Again, a lot of stocks sold off. This one is not a big cap, 29.39 billion, revenue 18.48 billion. So not a bad ratio there. P ratio is down. There's a strong buy. Now, I don't own Baidu. And these guys, I'm going to look at their free cash flow through this view here, because this converts it to US dollars. They have free cash flow of $122 million. They have to spend a lot of money on CapEx. It might be because of that AI business. They have to buy a lot of data center equipment, processors, GPUs. A lot of money has to go into that type of operation. So 122 million isn't very good. The best I can do is like $4 billion of valuation based on that small free cash flow number. On the balance sheet, they have 19.5 billion of cash, $14 billion of debt. So they do have a lot of cash on the balance sheet. Plenty of cash on the balance sheet. Yeah, Baidu is not my cup of tea. I prefer to stay in Alibaba. That's the stock that I'm invested in. And I buy an ETF of Chinese stocks. That's how I'm playing China. This one here is just a little too much risk, and it's not as known as Alibaba. My concern is just US investors, which is where I'm at, are going to have a hard time investing in Baidu. So for me, it would be a pass. I'm not really willing to take on this type of risk because it hasn't been a big winner over the last couple of years. So let's take a look at Visa. And good to see you, Ben Peoples. And Visa is one of those businesses that's really desirable by investors. You can see the slope of this valuation chart. It's gone up 84.82%, pays a small dividend. So Visa's just gradually gone up. $670 billion market cap. The revenue on the company is $37 billion. So it is a high price to sales ratio. You're paying, I'm going to see about 17 times sales for the company. That's an expensive ratio. And they got to be growing by a good percentage rate to deserve that type of price to sales ratio. The P ratio is 36 again. They have to be growing or that's an expensive price, right? It's a strong buy with no discount, according to analysts. Now let's take a look at their growth. They are growing 10%, and it's been consistent. The one year that was bad was the COVID year when things really contracted on online payments. People were at home watching TV, watching videos, going on Zoom meetings. And their growth has been really steady, and that's why the stock's, gone up gradually over time. The quarterly looks good, so each quarter has been good. So revenue is good. Green flag on the revenue of Visa. Free cash flow, 20.5 billion, and you see the growth of cash flow over time. 7 years ago, it was at 12 billion. Now it's at 20. Very good. That's why the stocks were working. Now their growth of 10%, the consistency, I'd probably paid 20 times their free cash flow, which makes it around 400 billion. And minus debt. We'll take a look at the debt in a bit. They have big margins because they really just provide a platform and people use it, and they get a percentage of the transactions that are placed on the Visa platform. So very high margins. Profitability is really good. That's why they're worth so much. Let's look at this profitability and cash flow. And I don't know that Visa has a direct threat or competition, around the corner. Maybe in the future, crypto might come in and compete against Visa. But for now, I don't see anything imminent. Some analysts believe, like I do, that, or I should say, I forgot to look at debt and kind of give you a value of the stock. So the balance sheet, they have 13.75 cash, 20.76 of debt. So they have a little bit of debt, $7 billion. So I had a value on their cash flows of 400 billion, but the market cap 670 billion. So Visa is just a little too expensive for me. I don't see that I'm going to make a lot of money on Visa. It had a very good year. If you look at the last 12 months, it's had a good year. It's just a consistent grower. It's brought a lot of investors. They're sticking around. The stock price keeps getting higher and higher, more expensive. And I just don't think there's a lot of upside left. I think there's only downside potential. I wouldn't buy any Visa. I might even sell it if I owned it. I don't own it right now, but I think it's just too expensive. Within financial services, some stocks are doing terrific and they have better valuations, and that's where I'm going. PayPal being one of them. When we look at Visa, right, they're doing well, consistent, but let's look at PayPal, and I'll show you what I mean. PayPal has decent growth, good fundamentals, but the market hasn't really liked PayPal for a while. It sold it off after the big run up of 2021, and it's never really come back. But when we look at their fundamentals, they continue to grow their business. They're not as big as Visa, but they do quite well. And they have good free cash flow. They've grown their free cash flow up to $6 billion. They have good margins and good profit margin, good free cash flow margin. Now, it's not as good as Visa, but you're not looking at a $600 billion market cap. You're looking at $69 billion market cap. And when I look at the growth, I think that PayPal is discounted nicely. When I value PayPal, it is discounted by 51% because the cash flows are really good. They continue to grow. Even when I have just a modest growth rate of 6%, they have a good balance sheet, so I only discount by 8%. I get a very high value of those cash flows. So it provides a really big discount when you value the company based on the future cash flows. And when you value the company based on earnings per share, it also provides a discount. So for me, PayPal is a better bargain than Visa. Visa is priced, I think, at a premium. In a way, it's deserved because it's performed really well for a long time. But I'm into buying stocks maybe that are out of favor that then catch the market's attention and then they run up to their true value. And that would be Visa. That'd be PayPal. It wouldn't be Visa, excuse me. So let me see if I have Visa as a stock that I've analyzed. I don't think I have it, but let me double check. No, I don't have it. So those are my comments on Visa. Every time I look at Visa, I can't get to the valuation. It's just an expensive stock. And I've never been an investor in Visa. So hopefully those comments are interesting to help you. Brandon, good to see you. You want to take a look at Bill? Yeah, you You were asking about that on Discord. Let's take a look at Bill. Bill's a software company. I haven't looked at it in months, so let's take a look. So Bill Holdings provides financial operations platforms for small and mid-sized businesses worldwide. The company provides software as a service, cloud-based payments, spend management products, which allow users to automate accounts payable and accounts receivable transactions. Okay. So this competes with like Intuit, QuickBooks, and other types of companies that provide a software for these businesses to manage their little companies, right? Manage the billing to their customers, the collections to their customers, the paying of vendors, and so forth. Now, over the last couple of years, when I've looked at it, it had its moments. Now, it's really sold off. A lot of software companies have been sold off. Now, I would say that in some cases, I think the valuations are really good for software companies. Let's see where we land on this one. This is a $4.59 billion market cap company. Revenue is $1.42 billion. So you're paying 3 times, 4 times revenue, probably less than 4 times revenue. Forward P is 22. Looks like they're losing some money this year. Analysts think it's highly discounted. Let's see where we're at. So the revenue, they had a really good year in 2022. And since then, the revenue percentage has come down. Okay. They are getting bigger, but the percentage that they're slowing down by is concerning. Now, the most recent quarter, 10.89%. That's decent, but they are a small company. They should be growing faster. Okay. So this is their gross profit is good. They're probably going to have a good gross margin. Gross margins of 84.5. Software companies tend to be that way. They code their product once and then they can sell it to 1 million customers. They don't have to recode it every time. They just sell one more unit to these companies at a very good profit rate. That's why I like software companies. High margins. Cash flow is really expanded nicely. That looks really good. So cash flow is 343.7 and margins are 84. That looks good. They have a tiny profit in the most recent trailing 12 months, and they have good free cash flow margins of 24%. All right. So let's take a peek at their balance sheet, see what that's about. So they have $2.17 billion of cash, debts below that. So they have a net cash surplus of $399 million. So that looks good. So cash is $2.17 billion and debt is $1.77 billion. All right, so that looks good. Now, judging from their growth rate and their profitability, I'd probably value the company at like $6-7 billion. And they're right now at $4.59 billion. So this is a discounted stock. The hard part is, I could show a number of software companies, and probably a good one to show is Adobe. Adobe is beginning to work, but for a while, Adobe's been undesirable by the market. You see how it's really sold off over the last year and a half or so, 42%. It has recently caught a rally. It's going up a little bit, but you can see the damage has been done, right? And this is a software company that is a really good business. It's down 40% from over the last 12 months, the high to the low. But if I show you the fundamentals of Adobe, if you're like me, you would be questioning why investors dislike Adobe so much. They're growing 10%. Bill.com is growing 10%. They have stupendous margins at 89%. Beautiful. Profit margin 30%. Free cash flow margin 41%. Those are great, great numbers. And when I value Adobe, I get a discount. So back to Bill.com. Software companies are not getting a lot of love. But I think at some point, Bill.com will rise to its intrinsic value. It's discounted right now, and it could really rise. I'm playing the Adobe trade because it's better known and it has a solid discount. I'll show you that. I don't know that I have Bill as a valuation. I used to have it, but I stopped tracking it. No, I don't have it anymore. But I do have Adobe. Adobe, I still think, is discounted by 31%, even after that 20% run up, because those cash flows are just terrific. They have good profitability. And Adobe, I think, is just temporarily, the market is really interested in AI, data center. But when you have companies like Adobe continuing to grow at 10%, they're already a pretty big company, 89% gross margins, very high free cash flows. Adobe is just a really, really good company to buy into. So I'm going to continue to buy shares in Adobe. It's been doing the right things over the last 30 days. If you look at the monthly, it's up 20%. And when do they announce their earnings? We're going to announce on June 12th. So we're about 3 weeks away from that event. And I think the market's going to realize that, hey, Adobe should be a $300 billion company, and it'll get there because the value of those cash flows is just too good. And I think the same thing for Bill. I think if Bill continues to execute their business, the one concern I have about Bill is this growth rate has really slowed down. I mean, it's not like going from, 64 to maybe 50 down to 40. No, we're going from like 65% down to 14 in less than 2 years. That is concerning. Like, whoa, why are you guys slowing down so fast? And as opposed to Adobe, that's very consistent data. You look at the growth rate there. It has been very consistent. I expect they're going to keep growing at 10%. Remember the Visa example. Visa continues to grow very consistently. They have very high profitability, very high free cash flow. Well, that's Visa. They deserve that kind of treatment by the market. Adobe, I just don't understand why the market's hating on them because they have terrific fundamentals. They should be priced higher. So those are my comments on Bill. I hope you found them interesting and useful. I don't know if I looked at the forecast for Bill. Let's take a look if other analysts are looking at Bill. Man, come on now. There we go. Let's try that again. Okay, so we have 17 analysts looking at the stock. Best case scenario, it's a $100 stock. Worst case scenario, it's a $40 stock, which isn't too bad. It's already close to that number. 43% discount. Wow, analysts really like the numbers. And I tend to agree with them. I think it's going to be a consistently profitable company. I think this is a good play. Can't argue with Bill. I just think there's a lot of choices in software right now that are priced really, really well. And if you really like it, really makes sense to you, can't argue with it. I like it. So those are my thoughts on Bill. Brandon, good luck. And of course, on Discord, if you want to continue the conversation, glad to. When do they announced on May 8th? And what did they announce? Was the earnings good? Let's take a look at that real quick. All right, so here's the earnings conference call. Here's the press release. Let's take a look at the press release. So total revenue grew by 11%. And again, my concern is the percentage growth rate has been really slowing down. I'm concerned about that because if it goes from 11 to 0, this stock's really going to tank. It's going to go down because investors are going to be like, uh-oh, something's up here. Something doesn't make sense. Why aren't they growing any faster? They were growing at 64% less than 2 years ago. So that's one thing I would wait another earnings and see where they're at. Hopefully they jump up to like 20 and then the stock's like going to work. But if it keeps going down on that percentage, I'm concerned. I'm like, no, I can't touch that stock. That's what I would be thinking. Fundamentals look good. I think the business is a good one. Their competition is going to be from Intuit, which is a pretty strong competitor. And maybe others. But I think Intuit's gotten fairly big, and they also have the TurboTax business that is really good for them. So they might not have the focus that Bill.com has. So I like that. I like the focus. They could just start growing faster, maybe get up to 20, 25% growth. Man, this thing is just going to take off. So that is the homework on this stock is let's wait for the next earnings call. And if they start to grow better, this stock's going to work. If they can't grow, I'll be glad I didn't touch it because I don't think the stock's going to go anywhere. It's just going to continue to bump along the bottom. Anyway, and it's a good name too, Bill Holdings and Bill.com. Good website. So thanks for asking, Brandon, and thanks for your support. Michael Anthony, Pfizer, PFE, earning being crushed with profits. Yeah, Pfizer had a lot of interesting, to me, the fundamentals were looking interesting for Pfizer, but they surprised me on their last quarter. See, this is what I was seeing. I was seeing 31% growth, 22% growth. They had bought a company that had just gotten FDA approval on some drugs that cure some forms of cancer. And that looked really exciting. And they started to show their growth on the quarterly, but then they had this negative quarter. And I was like, where did that come from? If you guys can't grow, your stock is not going to move. It is going to be a value trap. It's going to stay at its current price. It's just going to bump along. They do pay a high dividend, but I'm not a dividend investor. I'm looking for my next Meta. I'm looking for my next Robinhood. I'm looking for my next lab, right? Which is up 60% in less than 2 months. I'm not this investor. So I'm waiting for another quarter. If they can get back on track and start growing, I'm going to be okay. I'm going to stay in the stock. If they show negative growth, I'm going to sell the stock because I don't know what to do with it. I thought they were going to start growing. The company historically has been a really good business, right? Even before COVID, it was a $40 billion market cap company. They did a lot with COVID. They really grew nicely. They took that cash. They bought some businesses. Good idea. They kind of refreshed their portfolio of drugs and pharmaceuticals. Great idea. I like the strategy, but they got to execute. Or maybe my analysis was wrong. Either way, if they can't pull off a growth quarter, I have to think about selling Pfizer. So that is my plan on Pfizer. Thanks for asking, Michael Anthony. Man, we are up to 38 people on the live stream. Man, now we're cooking. All right. So what else do we talk about, everybody? What other stock do you guys want to talk about? I can't end the live stream because there's too many people on. Let's see if we've got any other stocks on the earnings or any other stock that I thought was interesting to talk about. So XPeng, Google. I talked about Google. SPC picks. That was the first stock I talked about. But you know what? I'm going to say yes. We talked about this stock early. Let's do. So Michael Anthony, just before I go to Google. So Pfizer got an upgrade today. And you know, I'll put something out there. Where was Pfizer? Let me just look it up again. Some of these upgrades and downgrades, right? I don't track them all that close. So you were talking about it. So this looks like a great play. So dividends. Yeah, I could see a lot of investors liking Pfizer because that high dividend. And that makes sense, but that's not my game. My game is if I want a dividend, I'll buy a bond. I'll make 6% on bonds. I'll make 7% on bonds. International bonds, I got one bond, I'm making 11%. That to me is better than a dividend paying stock because a bond isn't going to lose substantial value like a dividend stock could. If a dividend stock loses 50%, but I'm earning 6% per year, it's still a super loser. I mean, it's going to take me 20 years to recover and make a decent, return. That's a terrible investment. I'd rather go into bonds. I get my income and done. Instead, I'm looking for something that, within healthcare, I'm looking for Catalyst. One year, it's up 43%. 5 year, up 444%. This is what I'm looking for. I'm invested in Catalyst. This is what I'm after. I'm fishing for marlin in the Atlantic Ocean. And when I look at Pfizer, it's like, I don't know what kind of fish is undesirable. Maybe some bad cod or something comes up on the net and you're like, oh, no, I'm looking for marlin. This is what I'm after. I'm after 444 or 43% over the 1 year. I don't want to bottom feed and deal with this down 19% or this down 35% over the 5 year. No, I thought they were going to recover. They were beginning to show those signs. The earnings were looking good quarterly. Then boom, they surprised me. Okay, I'm not going to stick around long on that one. So Google Alphabet, and that was SPC Picks. You joined at the perfect time, and we're going to cover Google. Tony, what is up? You want to look at TMDX? That's next on the list, buddy. Eric Johnson, good to see you. And I'm going to come back to your comment. Just want to acknowledge you're on. I appreciate you joining on X, and you are becoming a regular. Thank you, sir. And Michael Anthony, you're passionate about Pfizer. Keep bringing that passion. And I'll keep sharing my point of view. You keep sharing yours, because together I think we can help each other. Google Alphabet had a terrific earnings announcement yesterday. They opened up their garage, and just to use an analogy, and inside their garage, there was this shiny Harley Davidson next to a beautiful Lamborghini, all beautiful and shiny, polished. And next to that is, another, beautiful Lamborghini SUV. It's just a beautiful garage. Well, Google opened their garage and they go, we got robo taxis, the real deal. We got this AI business that's being used higher rates than any other AI platform out there. If you measure the tokens that are being bought, you look at their Google Glass idea. You look at their big bets. They're really coming to the market really strong. Really, really nice. Google's discounted. I'm gonna go straight to my valuation. And I've covered Google, I don't know, 50 times in the last year. It's my second biggest position. And it had a good day. It's one of the best businesses you can own out there, and it's discounted by 17%. One shouldn't expect that great companies are going to be discounted by 50%. If they are, you should buy them and buy as much as you can. But a 17% discount with a company that has that momentum is a really good opportunity. I've been buying Google stock recently. I've been buying Meta stock recently. Those are my Meta's my favorite, and my second favorite is Google Alphabet's my second biggest position. So I think Google Alphabet's the real deal. The announcement they had yesterday, I think, reminded everyone that it's Google. These guys are really, really good. They're really smart. They have great products. I could spend 8 hours talking about the products that Google has. And I think at each product category, it would be either number one or a competitive product. They're number one in search, number one in YouTube or streaming content, and they're growing faster than Netflix. They're number three in public cloud behind two forces that are Amazon and Microsoft, but Google's growing faster than those two. And now when it comes to robotaxi, they're number one. Nobody else is really, well, Amazon came out with Zoox. They're operating in Las Vegas. But those are the two companies in the US that are currently operating robotaxis. And Waymo is way ahead of everybody. And we'll see how that plays out. But I'm a buyer of Google stock. So let's move over to TMDX. TMDX. That's right. You were asking about this on Discord. So these guys are a commercial stage medical technology company engages in the transforming organ transplant therapy for end of stage organ failure patients in the United States. Okay. The company offers Organ Care System, a portable organ perfusion optimization and monitoring system that utilizes its proprietary and customized technology to replicate near physiologic conditions for donor organs outside the human body. All right. Let's take a look here. So organ transplantation, right? It's quite common. You may know somebody in your life that's had an organ transplant. Okay. So their product, wow, look at that. So here's a lung, heart, liver. So okay, so we're dealing with a healthcare company. They're in the organ transplant area. Okay. Take a peek at their earnings presentations. So Q1 revenue was $143 million. So year-over-year growth of 48% looks good. Quarter on quarter of 18% looks good. That's momentum. Okay. Now they're buying aircraft, obviously, so they can, let's say they have somebody who donated an organ and then they're in Denver, Colorado, and that organ needs to get to, I don't know, Los Angeles, and they can get it over there. Okay. All right. So total revenue is going up quarter after quarter. Okay. So that looks good. Now they're slicing up their revenue into different categories. All right. So it looks impressive. Looks like it's a good growth. Now let's take a look at the chart of where these guys have been. So healthcare space, there's a lot of good price stocks. So they were booming for a while. Man, look at that. They were up 362%. Then the market decided, you know what? We're going to sell things off. And it sold this stock by 65%. But now the stock is up 102%. Whew, man, that is volatility. In 2 years, this stock's been places. It's been under 50. It's been above 150. And now it's at 121. Okay, so we've got that. Now let's take a look at fundamentals. Let me close some of my browsers. So TMDX. So $4 billion market cap company, 488 million in revenue. So 9 times revenue is, I think, what we're dealing with. Okay, that's not bad. P ratio is 86. I'll confirm revenue growth, but I think it's going to be okay because of that revenue growth. Forward P is 64. Analysts think it's fairly priced. It did run up. Okay, it did run up to 121. If we had looked at this thing a month ago or 2 months ago, it would have probably looked like a beautiful opportunity. Now we've seen the big run up. Maybe the market's realized, hey, this company's special. 64% growth rate. If we look at the quarter, compares this quarter, Q1 25, to this quarter, and it's growing at 48%. That's very good. 64% revenue growth trailing 12 months. Free cash flow, they don't produce free cash flow. Now, if they have to put a lot of capital into the business, it may be a problem for me as an investor, because my recipe for success is free cash. But let's continue on. Then I'm going to get to the statement of cash flows, and we'll look at that. Gross margins 59%, profit margin at 10%. Okay, that's decent. And they've been around for a while. Okay, it's not like this is not a new business. This is a business that is in growth mode. Okay. All right, so that looks good. Cash flow. So cash from operations isn't very high. Why is that? So net income. So their accounts receivable is accumulating. It's growing. It's getting bigger. And that's why there's a negative effect there. So that is interesting. Why is that? Are they billing people, billing insurance plans, and they're not getting reimbursed? That's a big question, because that's a substantial number for them. And here's the CapEx number. Okay. Now they are buying equipment like those jets that they bought and all these. When you look at their product, right? Their product is part of their service and their product. This is a capital expense. These carts with electronics on them and software and these hardware systems to preserve that organ, they cost money. And you have to deploy capital in order for these to be there. It's not like, we saw Palantir. Palantir doesn't have to create hardware items like this. Even like NVIDIA, they just make GPUs and they ship them out. But these guys, they actually buy this equipment, and they don't sell the equipment necessarily to the hospital or anything. They provide a service, and they need this equipment to provide the service. When we look at their financials, it's costing a lot of capital to get this to operate this business. That's a concern because we're just not accumulating cash. When we look at the balance sheet, we've got more debt than cash by $208 million. Let me look at the balance sheet a little closer and see if debt has grown over time. So back here, they didn't have much debt, and then they started to grow, so they borrowed money, but it hasn't grown a whole lot. That's good. Good job, guys. You didn't grow your debt. You grew your business. So on this one here, I would wait because of a couple of things. One, the stock has run up. Second, we don't know if they're going to produce cash at a very high rate. And we have to wait to let the CapEx number settle down, because maybe the CapEx won't be as high over time, because once they buy enough equipment, they don't have to buy as much equipment over and over again. But right now, it's too early to tell. Let me look at the quarterly and see if it's coming down, the CapEx. So here it is. So see here, they spent a lot of money in one quarter, down. And they're showing periods where it is coming down. Boy, if they can get it down to like 20 million a year and they can let this free cash flow grow, that would be phenomenal. But for now, I would hold off. The stock price has really run up. I just think there's an opportunity or there's a risk of this stock coming down before it goes up. It did go up really nicely before, and then it crashed down. I mean, it crashed down fast from here to here. That happened over 5 months, and it came down 67%. Whew. That had to be a rough ride. And let's go look at the quarters where this happened, right? So this happened from September 24 through January 25. And let's go look at their financials. What was going on during those quarters? So here's September. Here's December. Growth was good. Growth was good. Okay. Free cash flow went negative. So maybe that got under the skin of the investor. They're like, whoa, you were beginning to show positive cash. You went negative. Next quarter wasn't all that great. Margins also came down from 60 down to 55.9%. They have recovered back to 61%. That looks good. Yeah. So the data doesn't, data like this is hard to gain confidence in because you're all over the place. You're going up and down. Remember the Visa example I showed earlier? The reason why people really like Visa is that it's smooth. It's like it just keeps growing nice and smooth. Costco, smooth. People love it. Now, I think both of those stocks are priced too high, and there's a price you have to pay for consistency, I guess. And then there's the other end, which is super inconsistent data is hard to get confidence behind. This is a stock that is hard to get confident behind. So that's how I see it, Tony. I think this one's really risky. Man, if I know that it's hindsight's 2020, right? We can't invest using the rearview mirror, but we got to wait for this thing to come down to maybe $60 a share, and then it'd be a great opportunity if everything else remains the same, if it's growing at the same rates. But I'll go back to Catalyst. This is a good looking chart, right? But, or I should say, overall, stock investors are happy, 636, but it's been a rough ride. It's been a smoother ride with some other companies in healthcare. And that's where I was trying to go. And right now, those are my thoughts. Is I think there's a higher risk of this thing is going to come down versus it's going to continue to work, because there are no fundamentals to price this company on free cash flow, and their valuation is pretty expensive. So we'll see what happens. And those are my thoughts there. Good luck with your decision there. And thanks for bringing it up, Tony. That was a good one. That was interesting. We have the investor call tonight, so we can talk about it if you'd like. I'll have the company fresh on my mind. We can talk it through. So Eric Johnson, can you talk about how you consider different time frames for bonds versus money markets? Very good question. So let me put it up here. So time frames of bonds versus money markets. Right now, money markets look really attractive, right? 4.2, phenomenal. But if we go back to like the 2021 year, they were terrible. Interest rates were really low, and your money market account was paying you like 0.5%, less than 1%. So being in cash was like, okay, you're losing purchasing power compared to inflation, right? All right. So right now, I'm not getting complacent just staying in money market, because that 4.2 may not be there forever. The Federal Reserve is likely going to start reducing interest rates, especially if we have a higher interest rate environment. They're going to want to lower the borrowing rate on short-term bonds. That's going to directly hit money market accounts. So I've actually been buying bonds, actual bonds, and the most recent one that I bought into is one issued out by Hewlett Packard. Gives me a yield of 6.3%, and it's locked in for 5 years. So I get 6.3% on that bond for 5 years. I control the term, 5 years, and I get to make 6.3%. If interest rates fall substantially, I still make my 6.3%. If they were to rise a lot, I'd probably feel like, oh man, I tied up my money and I'm giving up some potential gains. But when you talk about, like, I think your question is addressing time frames, right? Capital that I may want to deploy for the next year, money market accounts are okay right now, and maybe a short-term bond ETF. If you see yourself using that capital in the next year. For me, capital that I'm not going to touch for 2 years, I should lock in on a bond, and that's money that I'm not going to use to put into stocks. I'm not going to use it in anything that I can think of for the next 2 years. I lock it in a bond ladder and just have that money produce consistent rates. So you're asking a very important question. I don't know what your age is. If you're an older person, bonds become really important, because I'm 56. I'm not retired yet. I will be someday. You want to have, kind of, in my case, I want to have the next 5 years completely funded by bonds. My standard of living doesn't change one bit, whether the market goes up, 30% a year or goes down 25% a year. I have 5 years of cash coming in from those bonds, and I have some longer term bonds as well. You're mid-30s. Now, in my mid-30s, I was still trying to grow my capital as fast as I could. So I was in real estate. I was in growth stocks. I was trying to find better growth stocks and staying in growth stocks. And that's what I would tell my 35-year-old self, is grow your wealth as fast as possible. And bonds are not where you're going to grow your wealth. Bonds are going to be where you protect your wealth. So if you're fortunate and you have lots of money, you've already have $20 million, $50 million, you're protecting your wealth. Bonds make a lot of sense. Lock in a good rate of return and you can preserve your wealth. But if you're 35 and you're like, no, I want to make $2 million over the next 20, 30 years. I want to make $5 million over the next 20, 30 years. Then stocks is where it's at. If you're maybe saving up for a house, you're mid 35s and you're like, hey, mid 30s, excuse me. And you do want to earn a good rate of return, but you don't want to be in stocks because you could have a pretty bad year like 2022. Yeah, you could think about some longer term stocks. I have found if you want to keep your money liquid, ETFs give you really good liquidity. Here's a short-term bond ETF that I own. This is very liquid. You can sell it every day. You can buy it every day, no problem. And these are terms that, you know, they go into 2026, 2029, 2027. And these guys are going to lock in the interest rate a little better than a money market account. And the 1 year return on this, because you've had a mixed market, is 2%. So it's gone up 2.04%, and it's paid a dividend of 3.57. So you add those two, we're at 5.61 rate of return combined, right? So this is how you can get into a bond that kind of gives you more longevity on the good rate of return versus money market. Because money market, you're dependent on, like, let's say you're on a money market account with your brokerage or your bank. You're always kind of waiting for them to tell you what your rate's going to be. Short term, I think they're going to go up a little bit, but I think the Federal Reserve is going to cut short-term interest rates, and that's going to hit money market accounts. So if you're going to buy a house soon, you got to think about money market accounts, BSV, tie your money up in bonds. You're thinking the right way. And hopefully the higher interest rates are going to cause home prices to come down for you, and you can get a good deal on a house, and hopefully it works out for you. You know, I would love to have a conversation, like if you were on one of the investor calls, and we can talk it through. I can be more helpful, but hopefully what I shared with you was interesting and useful. Mr. Flack 188, thanks so much for the super chat. Thank you, sir. That's awesome. So let me oh, cool. I'm glad it was helpful. Let me get this comment off, and then we're going to get into Chevron. So CVX, thinking of selling. So Chevron, thinking of selling in for good, or I guess you were thinking Google or Meta. Okay. So I own all three, and I'll give you the ending of the story, and then I'm going to give you all the details. I think Meta is the best quality investment I can make right now. It's a big, well-known business. It's growing faster than its rivals. It's set up really well for the AI business. It just makes money in a terrific way, and it has no big competitor. I guess the only thing that's going to limit it is governments that say, oh, Meta, we don't like the way you hold data. Number 2 on that list is Google. And Chevron is not a stock that, and I don't know your age, but I'm 56, and I'm telling you that I own like $280,000 of Meta. I own $60,000 of Chevron. And I own like $190,000 of Google. That tells you like Chevron is not a wealth creator for me. It's a diversification play. I'm in energy. It does pay a dividend, so that's good. But it's not a wealth creator. It doesn't take, I don't put, $100,000 into Chevron and expect 5 years later that it's going to be 200,000. I expect that it's going to go up in value and it's going to pay me a dividend. On Meta, I expect I put 100 grand in, I'm going to get at least 200 grand out in 5 years, if not more. Google, same thing. So if you're into growing wealth, I prefer Meta. Second place is Google, and Chevron is not a wealth grower. Now let's get into details. We're going to go straight to the valuations, which I have. We're going to start with Chevron. So Chevron is the second biggest oil company in the United States. The biggest one is in Saudi Arabia. I think it's called Aramco. But in the United States, we got Exxon, and we have Chevron. And Chevron is a very well-run company, but energy's been around for more than 100 years. And Chevron was part of Standard Oil, which was the Rockefeller, fortune. They're discounted by 27%. So would I argue with an investor and say, no, I don't think it's discounted? No, I would actually agree. But what do you want to do with Chevron? Do you want this to take your 100 grand and turn it into 200 grand quickly? Well, I don't know that it's going to do that unless oil prices decide to really go up. Here's Chevron over the 5 year, 50%. It's not bad. Not bad at all. You add that dividend, maybe you're up to 70%. And you look at the max, right? We've seen certain periods of time when you had high oil prices and it really goes up. And especially here when we had COVID took Chevron stock price and just put it in the dumps and then it went up. But let's stick to the 5 year. That's a decent return. Now, when we look at, let's go to Google. Google's discounted by 17%. But we just talked about, twice on this call, we talked about their impressive presentation of their AI products. You're in your 20s. You'd like to buy a house next year or two. Okay, cool. Good to know. All right. So Google has a fantastic future. And I think it's been sold off. And that's a fact. So let's look at its chart. Over the 5 year, this would have delivered that type of wealth creation I'm looking for. You put 100,000 in, you get more, you get $241,000 out. So mission accomplished. That's what I want, I want a wealth grower. But let's look at Meta. And Meta beats Google by a little bit, 170% rate of return. So you put 100,000 in, you get 270,000 out. That's better. And we look at Chevron, it didn't grow wealth as quickly. Okay. Now, if you're in your 20s, first, good job for learning how to invest and continue to learn. If you become a good investor and just get better every year, you're going to have more money than you need. Investing is not like you have to have an IQ of a gazillion or however they measure IQ. You just have to have curiosity to learn, be willing to learn, take on, new disciplines, learn the arithmetic, find a recipe that works for you, and then stick to it and just grow your wealth. Be disciplined in life. Don't spend more money than you make. Save more than 10% and you'll have lots of money. So in this case here, 100 grand, Meta delivers the most wealth creation, but this is looking at the rear view mirror. When I look at Meta, Meta has the strongest business of the three stocks that we're looking at. When you look at Meta's social apps, you have more than 4 billion people going on a Meta app, just super strong, really strong moat, competitive barrier. Competitors can't touch Meta when it comes to social. Looking at the future, it's discounted by 29%. And that's based on the data we have today. As they grow, this valuation will evolve. But for now, I'm buying the stock because it's discounted. It's clearly discounted when I look at Apple, Microsoft, even Amazon that I do own and I'm not selling it. It's priced too high. It's priced at a premium. And what we need to find is stocks that are priced incorrectly, inefficiently in the market. So back to your original question, which was if I was needing to pick between the three stocks, and let's say I only had one stock to buy, it would be Meta. And if I had a lot of capital and I needed to diversify, all three are good. But I think the two that are going to grow nicely are going to be Meta and Google. I think I will show up, but 5 years from now, my money will go up more than 100% on both. Chevron, I think, is going to be similar to the last 5 years. It'll go up 25 to 60% and pay that dividend, but it will not be a wealth grower like Meta. And that's my number one. So that's what I would do for me. So that was a good question. Thank you. And thank you for the super chat. All right, guys. So I got to go. I have a commitment and I'm 2 minutes late to it already. But this was a cool stream. And I appreciate you guys joining. I really do. I hope you guys found it interesting. And I will be streaming again tomorrow. I'm going to stream in the morning at 9 a.m. Eastern. And then I think I'm going to stream again at 3:30 Pacific or at 6:30 Eastern, because it ended up drawing a very big crowd. And it'd be great to see you guys again tomorrow or see you in the morning. So thanks so much for tuning in. I really appreciate the questions and I appreciate the super chat. Thank you, everyone. Have a good night.